So shall we start with?
Yes, we are live.
Ladies and gentlemen, good afternoon to all. I extend a warm and hearty welcome to all of you to this insightful session on GSTR 9 and 9C7. Today, we are honored to have two exceptional speakers with us, P. Subhashini Ganapathy and P. S. Renuka, who will guide us through this technical topic. Both speakers have extensive experience and expertise in the realm of taxation, and we are fortunate to have them share their knowledge with us today. Let me briefly introduce our distinguished speaker, C. Subhashini Ganapathy. Founder partner of Subhashini and Associates LLP is a distinguished specialist in direct, indirect, and international taxation with a qualification as a forensic auditor. She is a prominent speaker on international taxation, tax-related topics, and a motivational speaker for students. Subhashini ma'am GST expertise is recognized by the Institute of Chartered Accountant of India and Ministry of Skill Development, and she actively participates in GST awareness initiatives in Tamil Nadu. Subhashini ma'am is a member of various professional committees, a guest lecturer in numerous colleges, and runs a successful YouTube channel. We welcome you, ma'am. And on the other hand,
Thank
we have CA Renuka Murali. CA Renuka Murali, a chartered accountant and a partner at MSJ Murali & Co. since 2013. Holds an MPhil degree in Commerce and UGC lecturership certificate. She began her career as a lecturer and has been involved in various education institutions. Renuka ma'am serves on the Board of Studies for several postgraduate departments, is a visiting faculty member, and is recognized as a GST trainer by the Institute of Chartered Accountant of India. She has delivered lectures on VAT, service tax, and GST and holds key position in the Hindustan Chamber of Commerce and the Society of Auditors. Renuka ma'am expertise in GST extends to training Tamil Nadu state GST officers, making her valuable resource in the field. We welcome you, ma'am. We look forward to an informative and engaging session. Please join me in giving them a warm welcome. Let's go into a session.
Thank you, Nivetha, for the wonderful introduction. I request Renuka to start the session.
Thank you, Nivetha, for giving us a kickstart on talking about GSTR 9 and 9C, where the date is 31st December. Another too much of thrilling for all the articled staff and the trained staff of any CA office who practices in GST. Now, without much ado, we'll just jump to the topic because it is very difficult to condense the entire 9 and 9C job in a 3-hour session. Because at the end of the day, it is you who are going to submit the final data to your principal chart accountant, whose signature entry depends upon the amount of work and the amount of corrections that you make with respect to GSTR 9 and 9C. Before going into GSTR 9 and 9C, all of you, for all practical purposes, October 31st, you would have submitted the last tax audit report, and except for the transfer pricing reports, you would have submitted everything. Where generally, what do you report in a financial? With respect to tax audit, you report that the financials show a true and fair view of the affairs of the business. And section 44 in 3CB, 3CD, 44, clause 44 of 3CB, 3CD, as one particular clause in the entire 3CB, 3CD, which talks about the GST implication, what is the input availed, etc., etc. Now, that is where the two roads become one. Both the income tax and GST, they try to travel on the same track, which was not there before. Earlier in indirect taxes, income tax filing was a separate thing that was happening, and GST filing is a separate thing that is happening. So, what exactly are you going to do? An audited financial is technically a auditor signs and says, okay, so this is the turnover made by this organization. These are the expenses that are being spent. This is the income of the company, and this is the profit on which tax is payable. You certify that these expenses are correct, all the rules of all the provisions of income tax has been followed, so on and so forth. So, what do we actually do in GSTR 9 and 9C? What exactly do we do? It is an audited account, right? You cannot make any corrections there because it has been signed by a statutory auditor. Just give me a minute. Just signed by a statutory auditor. Do you think anything is possible? Do you think any corrections can be made in the audited financials? My session will start only from these questions. Can you make a correction in audited financials? please answer in the chat box.
And this is definitely going to be an interactive session. So both Renuka ma'am and I will not proceed until we get some responses, at least for us to have the comfort that someone else is listening.
Exactly. We don't want to believe that we are just talking to a system. We want to believe that we are talking to some good, interesting.
At least I can be a
youngsters.
little softer. Renuka ma'am is a lecturer. So you know what you can expect from her. So please respond. Can we at least put one hi in the chat box to understand someone is there listening to us?
Ma'am, in YouTube, they are saying no.
They're saying
Okay,
no.
so
As
is it getting live streamed in YouTube? Okay. So,
Yes. Yes.
okay, so you will guide me to,
they say
because
they
I do
cannot
not
make
have an
changes.
access to the YouTube. Yeah, please let me know the answers that are being posted there. Okay. It is a
Sure,
no,
sure,
that
ma'am.
is a correct answer. From there, we'll proceed. So when it is a no, then what is our job? To say that you cannot make any corrections in the audited financials, what is our job? Our job with respect to GSTR 999C to match the data that is reported in the monthly returns in the previous year of financial year 22-23 and to certify whether whatever that is reported as turnover in the books of accounts match with the returns that you have filed. So what you have been doing for the past 12 months from the say let us take the case of the current financial year 22-23. What have you been doing? You have been filing your monthly returns. You have been filing your GSTR 1 before 10th of the succeeding month. You have been filing your GSTR 3B before 20th of the succeeding month if you are a monthly filer. If you are a quarterly filer, every quarter you file and you pay it under the QRMPS scheme. So what happens is every month you say, okay, see, this is the turnover for the month and this is the GST I'm liable to pay. This is the input I'm eligible to claim. This I have claimed and I set up this. You have been doing for 12 months. So when you do data filing on a monthly basis, there is every possibility that some data will be missing. May it be the turnover or may it be the input tax credit. So our job in GSTR 9 and 9C, the government gives you an opportunity to consolidate and say, oh, here, sir, these are the 10 transactions that have happened over the period of 1 year from 22 to 23. Unfortunately, I have reported only 9 transactions. So, one transaction pending them reporting right now because my statutory auditor says there are 12 transactions of turnover in the books which he has certified. And of the 12 transactions, only 10 transactions I have reported. I am reporting transaction, the left out transaction. That is what is the purpose of annual return. So, to condense, I would say annual return is a consolidated return for a period of 12 months whereby you give the summary of transactions that you have done in your GSTR 1 and GSTR 3P for the period of 12 months. So, having said that, how do we go about doing the process? Technically speaking, we keep telling our dealers, we keep telling our clients, the groundwork of GSTR 9 and 9C must have completed before the tax audit. That is the exact way of doing a tax audit. Before completing tax audit, before helping your principal officer to complete the tax audit, your job of tax audit itself should involve groundwork for GSTR 9 and 9C. If you had done that, then your statutory audit turns out to be correct, and also filing GSTR 9 and 9C becomes very easy because what is that is you verify in tax audit? What is it that you certify in a statutory? What is it that legal complaints you say? If you have prepared your auditor's report, if you have prepared the CARO norms by MCA, you say there are no statutory dues for the year. How does an auditor certify? Is GST not a statutory due? So if the due is there, shouldn't you have made a provision before preparing the financials? So this is the importance of GSTR 9 and 9C. Though a chartered accountant is not required to certify, it has become a self-certification now, whereby a dealer is supposed to report all the left-out transactions, may it be the turnover and may it be the input. So having said that, if we say may it be the turnover and may it be the input, is it just mere sales that appears as a schedule number in your financials? No. The sales consists of too many types of transactions. There is a B2B transaction, there is a B2C transaction, there is a B2C large transaction, there is a self-invoice transaction, there is an export transaction. Like that, there are a number of supply of services and supply of goods which are required to be reported with respect to the net turnover. So technically speaking, if your turnover as per your financial shows 10 lakhs, your GSTR 9 should also show 10 lakhs. If it shows 9 lakhs, you have to explain why there is a difference, pay tax along with interest. If you have paid excess, then also you have the duty to report those transactions. The entire concept of GSTR 9 and 9C. So technically, you are giving only the summary report of the GST transactions. May it be inward supply, may it be outward supply. The entire gamut of transactions have to be reported in the form of GSTR 9 and 9C as far as this filing is concerned. So you have a 2-month period. The 2-month period has already started. Today we are in 4th November. There will not be any extension of time. So by 31st December, you are expected to upload GSTR 9 and 9C without any delay, because for each day of delay, there is a penalty that is lying. So the work before you is to commence the work of whatever you had done in your tax audit related. So can you start afresh? You cannot start afresh, because the very first thing that you do before commencing a GSTR 9/9C activity is to keep the prior period data ready. Like how you always, when you do a tax audit or when you prepare the financials for the current year, the very first thing is check the opening balances, right? That would be the standard norm that we follow in an audit documentation. The very first activity for a financial checking, you start check the opening balances. Where do you get the opening balances from? You get the opening balances from prior period data. Same way, even while preparing GSTR 9/9C, the very first thing that we have to do is keep the prior periods, the last year's GSTR 9C in hand, because there we would have recommended so many things, there we would have reported future data would have been reported, which you are going to see one by one. You will also, there might be an audit comment there as to some money would have been paid through DRC, or some activity of 21-22 might have been done in 22-23. There will be so many data that you can cull out from the prior period of GSTR 9/9C. So the very first documentation that is required to keep ready for the purpose of doing current year audit is to keep the GSTR 9 and 9C for or pertaining to the financial year 21-22 for the financial year 22-23. So having said this, how do we go about? I am handing over the proceedings to Shubha. Shubha, please continue.
Thank you, ma'am. Ma'am, I'm just seeing the first slide. So can we just move the slides? So thank you for the wonderful introduction, Renuka ma'am. Of course, this is like definitely a kind of, if we say this is just to represent and reclassify the data which we already have, because we've already done the stat audit and the tax audit. This is the third limb of reconciliation that we are doing. But as ma'am said, like, why is this still relevant? Because of a lot of GST audit, why the responsibility is actually shifted onto the taxpayer in terms of the turnover below 5 crores, etc., where we don't sign the GST returns. Ma'am, can I take control of the slide, ma'am, so that I can... Or Kavin, can you help me move to slide? Yeah. So ma'am has actually covered all this. So the very idea is GST earlier in the indirect tax regime, if you ask, where there are not stringent provisions to penalize the people who are non-compliant, and why people are so compliant after GST. So all of us are visibly seeing that, you know, people are getting into the compliance side. Basically, because now the compliance is easy and the non-compliance is very, very difficult. And as you know, everything is driven through technology, and whatever gaps we see, GSTR 1 versus 3B, 2A versus 2B, 2A versus 3B, 2B versus 3B, etc., whatever combinations you give, everything is just picked up in one go. And the officers are able to see the red flags raised in terms of the huge input accumulation, or supply is not provided, or there is a mismatch in the ratio of your purchases versus sales and huge stock accumulation. There are various other points which actually triggers the GST audit. And of course, like all of us are facing GST audits from the officials. Now, having said that, when there is so much of monitoring mechanisms and when you are allowed to do a voluntary compliance yourself, then I think we need to be doubly careful and doubly detailed and sure in every data which we are presenting to the department. Because like whatever we file on month by month, like GSTR 1 and 3B, of course, there are connections, there are trails from the previous months, previous year, etc., which we do. Maybe practical scenarios, we just remember one odd transaction which we have to amend, we forget to give the corresponding effect there, or input, we decide that we'll take this input now and we miss giving the corresponding effect. And with the amendment which has come in now, which says that, earlier it was a input register in toto. So whatever input we have, you just keep accumulating it. And when we say, like, we always used to adjust the input register to say that we have just taken this. Now with the 2B reversal, that also is going to be difficult. Moving on to the 9C, after having understood the detailed introduction on how important each table, each number, each data you're going to give it to the department, because this is, all of us know, this cannot be revised. So just one time opportunity, do all the groundwork, keep your working papers ready, and don't wait until the last minute where we create all the confusions. So keep every working paper through a link. Please avoid hard coding numbers where tomorrow even you will not understand what you have done. So this return replica should be supported by a detailed working paper in hand, so that you can refer. Even if there is there will definitely be red flags, there will definitely be disproportions in the business, because every business is not the same. Even if it is the same kind of business which A and B are doing, both of them will have different ratios. So when the AI picks up, it will definitely pick up data. That is not our concern. As long as we have detailed backup working for each and every item, each and every number we code in there, then I think we are good. So applicability, I think all of you all know. So if it's below, then if it's lower than 2 crores, then there is no requirement to file your GSTR 9. If it is below 5 crores, there's no requirement to file your GSTR 9C. And if it is below the threshold limit, then it is kind of deemed to be filed. So can we move on to the next slide? So now just to ask you a basic question, maybe very basic, but just to understand if you're there and you're interacting. GST, we say it is one nation, one rate, one tax. Suppose I am having business in Tamil Nadu, Maharashtra, and Karnataka. Of course, answer is there, but still, do I need to take 3 registrations, or one registration is enough because it's one nation, one rate, and one tax? Kavin, you need to help me with the answers.
I'm also waiting, ma'am.
Okay. Just to make my question clear, if I am having business in Tamil Nadu, Maharashtra, and Karnataka, my head office, registered office is in Tamil Nadu, branches in Maharashtra and Karnataka. Should I take 3 registrations or 1 registration? Because this is to simplify the tax, good and simple tax, one nation, one rate, one tax, no borders, borderless, and all the hassles are done away with. So is it sufficient if I take 1 registration in Tamil Nadu and operate all over the country? Well, that is the mantra of GST. Say, like, you can just go borderless. It's one nation.
3 registrations. Manohar is telling 3 registrations. Rajan Kumar overall 3 registrations. Moksham is telling overall, and Joji 3 registrations. 3, most of them 3.
So what does this overall mean? Only 1 registration?
Yeah.
Okay. So I think we'll have to give it to Manohar and all the people who said 3. For the people who said overall, having said that this is a one nation, one rate, one tax, we'll have to look at it only from the GST perspective. we have to look at our country as United States of India. Basically, because every state has its own GST management thing, because all of us would have seen that there is, whenever there is a charge, you buy something here in Tamil Nadu, you see there is a CGST 50% and SGST 50%. So the 50% of the management or the 50% of the revenue, the 50% of the collection responsibility, everything is managed by the state. And this is standard across India. So the other 50% goes to the center. And of course, the IGST transaction, whenever there is a transaction between one state and another state, that revenue also directly goes to the center, which comes in the overall budget of the nation, which is spread across the states for its own welfare, depending on various other factors. So back to this question, 3 registration is required. So now, how do we file your GSTR 9? So when you're considering the turnover, it has to be the overall turnover to be filed for your GSTR 9. And as ma'am said, it all should match with your financials. Having said that, there is a mandate by the GST law, which says each state registration. And when I say trial balance, I just don't mean only the trial balance. I mean the records prescribed by the GST authorities, be it your output register, be it your input register, be it your Kavin?
Is there a problem with your network?
Not sure, ma'am. Suddenly, like, but did I get lost in between? I didn't even realize. Suddenly, like, so from where I was like not audible.
No, the voice is getting
Okay,
disrupted.
I'll just say like every. Oh, is it okay? Just
Struck actually, pa. Maybe you can switch off your video and then speak, Shubha.
give me 1 minute. I'll just move my.
there seems to be an issue with the. Shubha, did you get it back? Kavin, you just tell who you are able to hear, myself or Shubha ma'am?
I can hear you, ma'am.
Shubha ma'am?
I'm not able to hear.
Okay, so what I will do until she sets up her network, I'll just continue where she has just talked about. We are just switching off our video just for the purpose of network issues. Okay, so please try to understand, friends. Lakshmi had given an answer in YouTube telling us one GSTR 9 and 9C for all 3 states. I understand, Lakshmi, from whatever you have typed, it is not one GSTR 9 and 9C for all 3 states put together. For each state of registration, you have to file one GSTR. Supposing you have got registrations in 5 states, you will have to file 5 numbers of GSTR 9 and 5 number of GSTR 9C. 9C per se is not a separate statement. It is a reconciliation statement of GSTR 9. GSTR 9, we call it as the annual return. And GSTR 9C, we call it as the reconciliation statement, which tells you the reasons for difference between GSTR 9 and the books of accounts. So, you prepare GSTR 9, find out the differences. If at all there is difference, you say, yes, there is a difference in GSTR 9C. If there is no difference also, you say there is no difference in GSTR 9C. That is here you get complete. As Shubha ma'am rightly pointed out, the limits we have already discussed. If your turnover for year, that is pan-India, I am not talking about one registration. If your turnover for the entire country is more than 2 crores, then you have mandated to file GSTR 9. Let me repeat, if your turnover here means the turnover that you report in your profit and loss account for the year. If it is more than 2 crores, then you are liable to GSTR 9. Then you may ask me a question. Ma'am, you are telling that there will be differences between the returns filed and the financials. What happens if there is a difference? Even if my turnover is less than 2 crores, the act says if you are do not for turnover less than 2 crores, GSTR 9 is assumed to have been filed. The act does not say you don't have to file. You can volunteer to file GSTR 9. So if there is a difference between the data reported in your monthly returns and your financial year, if there is a difference, and in spite of your turnover being less than 2 crores, it is better for you to report the turnover. Yeah, I am sharing the screen, Kavin, right now. Just give me a minute.
Sure.
Just let me know if you are able to see the screen.
Yes, ma'am, I can see.
So whenever you want me to take over, I can.
Yeah, I just filled the gap. Shubha just answered a question for Lakshmi Murugan. You can take it from the current slide, Shubha.
Sure. Thanks. And that's the
Shubha, are you there?
so. Sorry, sir. Just waiting for the slide. So, table 4. Am I audible?
You are.
Okay. So, on table C, the structure of this GSTR 9 and 9C are identified with tables, just like in our direct taxes are 44AB, like it is all. So here it's all tables, and table is the I would say the details of address inward and outward supplies made during the year or taxes payable. As a
Shubha, again your voice is breaking, Shubha.
Oh, but I have full internet connection, but I'm not sure. Once again, I'll just once try changing the. Am I good now?
Yeah.
Yes,
please proceed.
So, table 4 is the crux. As I told you, like every slide and every number you put is important. Table 4 talks about the entire supplies, which means this is the base of your GSTR 9, wherein you report all the numbers which pertains to computing your GST liability for this year. So here it goes. I will just take you through how a table 4 looks before moving on to table 5. And the introduction is like table 5 will be like outward supplies made during the financial year, just on which tax is not payable. So as we said, your financials, your tax audit report, and your GST are 9 and 9C should talk one language. So here you don't only report, not only report your taxable supply, just as you do it in your 3B, you also report the supplies on which tax is not payable. Similarly, the ITC, which is the fulcrum of the entire GST mechanisms, and all the audit, all the concerns, all the queries, all the demands, etc., everything comes due to this ITC. So either you avail an incorrect ITC, or you avail an ITC where you have a 2A, 2B mismatch, or you avail an ITC after paying like more than 180 days. So many issues around that. So this is again a very crucial thing. So table 4 and 6 are hardcore money matters. Any mistakes in table 4 and table 6 is going to be costly as in literal money outflow. And table 7, details of ITC reversed and ineligible ITC for the financial year. Table 8, I will take you through the tables in detail. When we look at it, I'll explain like what is what is ineligible and all those things in detail. And table 8 are all other ITC information. Table 9, details of tax paid as declared in the returns filed during the financial year. So how much of tax you have actually paid during the financial. Kavin, next slide, Kavin. And from table 10 onwards, so from 4 to 9 is the hardcore data of the current year. And after that, from 10 to 13, it is more like previous financial year's transaction reported in this financial year. So maybe you missed a sales in the GSTR 3B, you're reporting it now, you're paying a tax delayed. Maybe you found some input is ineligible, etc. So you pay. And all these things will be covered under from 10 to 13. And table 14 is, of course, the differential tax which you pay on this. Table 15 is, of course, the demands and refunds. Table 16 is more whatever you report over and above the table 4 to 9, which is like from whatever supplies you receive from composition taxpayers, deemed supply by job worker, goods set on approval, etc. So this table 16 probably I can cover it here in detail. So can people tell me like why this is important to report this supplies received from composition taxpayers, deemed supply by job worker, goods sent on approval basis? What is a deemed supply? Supply received from composition taxpayers is simple as it is very clear, and whatever we receive from a composition taxpayer, and composition taxpayer, I'm sure like all of you would know, a taxpayer, a GST registered person who decides not to collect tax and who decides to pay a lower percentage of tax out of his own money, whatever he has actually collected, because he is not collecting anything over and above the supply amount as GST. Probably if we want to equate to the income tax, you can look at this like a presumptive taxation. So I don't tell you like what is my margin, what is this and all. You ask me to report 8%, I'm reporting. Or in a non-cash scenario, you ask me to report 6% and I'm reporting. So if we can equate this to a composition taxpayer, he says like, don't ask me like, what is my invoice number, how I raised, how much I collected, all this. On my total turnover, I will be paying this percentage. So whatever my margin and what input I take, etc., is not relevant. I'm directly paying on my sales. This deemed supply by job worker. So what's this deemed supply by job worker? Any idea on this? Kavin, I'm audible, right? There's no issues.
Yes, ma'am, you're audible.
Okay, right.
Yeah.
So when we outsource transactions to a job worker, so let's say like I am in Chennai I want to do a assembly of one machinery for which one particular part is available in Coimbatore and my customer is in Erode. So what I can do, I can send all the materials to be done to Coimbatore. From Coimbatore, they can assemble everything and then they can supply the goods directly to Erode. That again, if the job worker is a registered person, then he himself can do it. If a job worker is not a registered person, then of course, like the principal supplier, which I am sitting here in Chennai, so I would register the job worker's premises as my premises so that he can supply directly to Erode customer. So this is generally the procedure. But where this is the deemed supply by job worker comes in, so this is whenever you give a transaction, maybe the tools, dies or assets, etc., you will have to take it back in a specified period or whatever things you do in a bill to ship to transactions, all that needs to be reported. That is pertaining to the job worker. In terms of sale on approval basis, in case if you are sending something to someone which is not a sale today, which is not a supply today, but which will become a supply, eventually become a supply when the client approves. Imagine a medical equipment which you want to give to a doctor. You have invented something which will find out like whether you have a sugar or a BP or a heart ailment immediately in 1 second. But the doctor needs to believe that it is showing the correct results. So you're sending, maybe the machinery is worth some 50 lakh rupees. So you want to send it to him. The doctor would obviously wanted to test it on minimum 100 patients before he decides whether he has to buy it. So these things will be like sale on approval basis. You have to send the goods. And if you say like, if you look at what the supply is, it's either delivery of goods or receipt of money or raising of invoice, whichever is earlier. So in this case, you have delivered the goods. You have not raised the invoice nor received the money. But the goods is delivered, one condition is satisfied. Immediately that will become supply. But if this is an exception, if this is a sale on approval basis, then this case, it becomes a supply only when the other person approves. So these three things are again important when you report your GSTR 9. And here this is the table 4, the primary table which I told you. Details of advances, inward and outward supplies on which tax is payable as declared in the returns filed during the financial year. So first thing is the segment A is supplies made to unregistered persons. So what do you do when you make a supply to an unregistered person? You put it under B2C in your 3B. So your consolidated B2C reported in your GSTR 3B or GSTR 1 and GSTR 1 should come here. So this again should match with your books, sales register, whatever you have maintained, and also with the income tax returns and with the ROC in case it is a company. So this is a universal rule that whatever you are reporting here in toto, which is the total of your GSTR 1 and 3B, should match with your GSTR 9, and your GSTR 9 total should match with your income tax returns and your general financials if that is applicable to either ROC if it's a Schedule 3 or otherwise. So your financial, tax and GST should talk one language, and this is the detailed schedule of that one language, like what we do in the normal financials. When we prepare, we just put share capital and we give the details to it. So here your sales reported in your financials and your income tax should total to all these details here. The B segment is supplies made to registered persons. So what is the difference between B2B and B2C? Can someone say? I know I'm asking all preliminary questions, but I'm afraid to actually take you to the next slide, because unless I get answers, I will not know to which level of audience I am talking to, or what is your understanding for me to move to the next level. So what is the difference between a B2B transaction and a B2C transaction?
Yeah,
And
there is
I
Shiva
request everyone
Prakashan
to
L.
be
Shubha was replied.
Sorry, ma'am?
Shiva Prakashan L has replied. I just raised a question on YouTube. Do you raise an invoice about B2C? He has said yes. So there are around 46 participants and they seem to be really listening and answering well.
Lovely.
Sivaprakasan says B2B is means business to business. That is the answer that you have got from Mr. Sivaprakash. Okay.
Wonderful, Shiv Prakash. Thank you so much. So this business to business
and
and
Manohar
business.
also has replied. It's the same thing.
Manohar,
yeah, please continue.
Yeah, Manohar seems to be very active. And all of you, like Renuka ma'am said, like she's excited about the participative audience. She is also preparing a set of questions in the back end, which she will post to you. And it's definitely going to be an interactive and question answer session. So be prepared. Now, this B2B and B2C, business to customer and business to business. So why this is important that we have to bifurcate both is basically, if you report something in B2C, that customer cannot take input of that GST paid to you. If you are reporting something in B2B, that is where the person can take input of the GST reported by you. But in both the places, in all the places for that matter, you're collecting GST and you're reporting it to the government. So in that, there is no changes. But if you change this column from B2B to B2C, then this is the difference. And I'm sure like this is a thing now. Can you now really take care of amending all this? No, this has to be done in the GSTR 1 and 3B level. So now it's more for you to know. And zero rated supply, export on payment of tax except supplies to SEZs. So zero rated supply. What is a zero rated supply? What is nil rated supply? So can I expect some answers from Manohar, Shiv Prakash, and others as well? Kavin, any answers? Difference between zero rated and null rated?
Not yet, ma'am. Zero rate is export from Sivaprakash.
Okay. Shiv Prakash is the only person listening. Okay. Zero rated and nil rated. Zero rated is totally, it will definitely be zero and people will not, I mean, the government will never change basically because this is pertaining to the export related transaction. And why export related transaction has to be zero? GST is an Indian law. You cannot levy it on a person outside India because again, GST is a destination based tax and the tax has to be paid by the customer. Here the customer is outside the territory of India. I'm not going into the definitions of what is an export, etc. So here we will not have time for all that. So zero rated supply, you will have to understand this is the export on payment of tax. So why this specifically says like export on payment of tax? Is there something which also says that export or without payment of tax? The answer is yes. If you do it with the letter of undertaking LUT, you don't have to pay tax on zero rate export related transactions. The idea is LUT is nothing but a letter of undertaking which you give to the President of India stating that in case if this transaction turns to be a non-export related transaction, I will pay the tax to the government. And in case of the, if you don't have an LUT, you simply pay the tax and you take the refund. That is the whole idea. And here, because there is money outflow, the revenue to the government, this is reported here. Supply to SEZs on payment of tax similarly, deemed exports and advances on which tax has been paid but invoice has not been issued. Inward supplies on which tax is to be paid on reverse charge basis. So all these things are revenue related items where we give the base for the government to calculate the tax which we owe to the government. So, and the green box gives the details of what all we don't consider here. Here the reverse charge basis is not outward supplies liable to be paid. RCM should not be declared in this table. So G line item, the G segment of table 4 considers only the inward supplies. The outward supplies reported elsewhere. Debit note, credit note, with no GST impact, again, is not considered here. And supply of capital asset, if be so, then that needs to be verified. B2C, B2B, etc. Like B2C is net of credit notes, etc. B2B is without netting off, simply because the other person is going to take credit, or you will have to report this separately to understand whether there is a debit note or a credit note, vice versa, for the other person to adjust in his or her books accordingly. Similarly, SEZ, the SEZ should be admitted by the SEZ officer, which means the SEZ should really be a qualified SEZ. Then the deemed exports and advances. So advances, all of us know, like advance is applicable on supply of services and supply of goods. We don't have to pay GST on advance, and of course the RCM on 9.3 and 9.4. Kavin, can we move on to the next slide?
Just a second.
And when you're reporting this, it's good if you report it without the decimals. Maximum decimal you can use is only up to decimal of 2 places. Otherwise, it will throw error. You will get a error like error invalid summary payload, and all of us know what we go through to this JSON. Yeah. So this is details of advances, inward outward supplies on which tax is payable declared in the returns filed during the year. So here, credit note in respect of transactions specified in B2E above. So what was B2E above? B2B transactions, zero rated supply, supply to SEZ, deemed exports, and advances. So all these things, until like all the exports, be it all those things, credit notes, if you have issued in pertaining to the supplies of all these, you will have to report it here. And debit notes, similarly, in terms of the B2E needs to be reported here. And supplies tax declared through amendments. So what is amendments? You have option to amend an invoice. Due to a change in, it could be a change in communication, or maybe a scenario where you, from Tirupur, you purchased 100 t-shirts and specifically customized, etc. And you found that there were like 25 t-shirts which are damaged. And instead of raising a credit note, etc., you say like, no, I want an amended invoice. I don't even want anything of the sort. It will be difficult for me to get the approval, invoice approval. In that case, the invoice itself is amended. So supplies tax declared through amendments, declared over and above, reduced through amendments, and the subtotal. So here, what are we doing? In the table 4, which we saw now, we declared all the supplies, the basis on which the tax was calculated. So here, what are we doing? We are adjusting that amount and arriving at the pertinent amount on which the tax shall be calculated. For example, if there is a supply of 1 lakh and there is a credit note issued, then there is a debit note issued, there is an amendment which would increase your liability, decrease your liability. Considering all this, then if my principal supply, that amount is going to be 80,000, then after this particular clauses of I to N, I will be arriving at that 80,000, because whatever I have declared in the first part of the table 4, until like the supplies, the advances, needs to be adjusted with all these to arrive at this. Because in case if I declare 1 lakh there and all these adjustments put together, the gross comes up to minus 20,000, then my tax should not be calculated on 1 lakh, but on this. Having said that, all these credit notes, debit notes, and any amendments upward, downward, which you are reporting, please make sure that you have sufficient data. And sufficient data as in if there is an error in the invoice, if you had passed some credit notes or debit notes or increase, decrease, etc. as an invoice amendment. Sometimes we do this additional invoice of 4. In case if we make a mistake in invoice number 4, we do a 4A. Then you report it later in all these adjustments. Please make note of all these adjustments along with the numbers. And as per GST law, we have to number the credit note and debit note, which of course is asked in the returns itself. We all would have done. But you need to maintain a detailed record and the reason for the debit note and the credit note. And shortly, like I will take you through where you will have to the GST when you're raising the credit note or debit, where you need not touch the GST when you're raising the credit note or a debit. Kavin, can we move on to the next slide? No. Oh, that the credit note one. Yes, thanks. So table 4, first part, we saw like what are the things which we'll report as supply, as why primary supply. Primary supply not in the GST context. Here it's a primary supply, all supply in total. The second part of the table we saw, I will adjust all that details which I reported in my primary supply to actually report the amount of tax which I have to pay on. Now, this credit notes and debit notes which we saw there, this credit notes and debit notes cannot be raised left, right, and center for all the mistakes we do. There are conditions on which you have to raise a debit note or a credit note. And unless those conditions are fulfilled, you will not be able to take credit of the GST, vice versa. I mean, either upward or downward, if it is not pertaining to these conditions. So what are these conditions in the GST? So here you will have return of goods. So if the goods are returned, so this return of goods again should be pertaining to the quantity or quality. So return of goods, for whatever reason you have returned the goods, that case, if you are able to substantiate why the goods were returned, then yes, there can be a credit note giving impact to the GST, basically because these goods were not consumed, therefore tax is not payable, therefore it can be reversed. Reduction in value, deficiency in supply. So in all these cases, so deficiency in quality or quantity, reduction in value. Maybe like we agreed for a price for a t-shirt as 150. Then I negotiated with some sales executive and I struck a deal that a t-shirt can be given for 125 rupees. Then without this communication being passed on to the person who is billing, if he had billed this at 150. So this is not an agreement with what I did. It is actually a reduction in value where I assumed and both of us agreed, both the parties to the contract agreed that the value of the goods will only be 125. So this case, this can be done. Return of goods, in case if I asked only for 100 or there was a deficiency in the quality, I can return it. And if there is deficiency in supply, in case of a service, if there is a deficiency in quality again, then this can be raised. But all these conditions are not just like, you listen to it and leave it here and go. When we are facing the GST audit, we will have to substantiate all that. And certain cases where we are asked to provide the email proof, the communication, how it happened, etc. And most of the cases in businesses, it just happens over a phone call. You decide and you just send. So that case, the only approval is that the other party has accepted the credit note, because without the concurrence, they would not accept the credit note. So, but remember, only under these conditions, credit notes can be raised. Imagine a condition where you are giving a discount. So, Kavin, can we move on to the next slide? So, imagine a conditions where you're giving a discount out of your invoice. So, in case if there is a discount which is given in the invoice itself. So, this again, I want you all to answer. If a price of a product is 1,20,000 rupees, I am giving you a discount of 20,000. Then my GST will be collected on 1 lakh or 1,20,000. The price of the product is 1,20,000. There is an agreed discount in the invoice itself of 20,000 rupees. So the net amount payable by me to you is 1 lakh. Now GST has to be collected on 120 or 1 lakh. Any answers? The question is very simple, guys. Come on.
Shubha Sivaprakash says 80,000.
80,000. Okay, maybe he. Oh, okay.
Yeah,
I said
Manohar
120.
says on net only.
Okay, I think Shiva Prakash also meant net only. He subtracted this 20 from 1 lakh. I said
Yeah, I have
120.
so many answers here, Shubha. Mini Chandran says net amount. Valarmadi says 1 lakh. Moksham says 1 lakh. Deepika
Lovely.
says 1 lakh.
Excellent.
Quite a good number of answers here.
Perfect, perfect. So that means all of you all clear that if there is a invoice within the, I mean, if there is a discount within the invoice, then it is clearly said that you will calculate GST only on the net. So in case if there is a discount which is given after the supply has been effected, so you don't put this 20 in that invoice, but you want to give this 20,000 discount after billing for 120 and after collecting GST on 120. So what are those conditions here? Such discount is established in terms of an agreement entered into at or before the time of supply and specifically linked to the relevant invoices. So here, this is like, maybe if you can visualize a kind of transactions of dealership. So let's say like if there is a agreement between you and me that you will sell 100 kilos, I mean 100 packets of Boost. So if you sell 100 packets of Boost, I would give a discount of 10,000 rupees to you. So this is entered into an agreement decided before, and it is maybe it is not linked to the specific invoices, but it will definitely be linked. My agreement will definitely, I'm talking about a practical scenario. My agreement will definitely say my discount or this particular offer starts from April 1st. So here I will be able to link my agreement with the invoice numbers that whatever invoices I have raised after April 1st, I can give this benefit to. Maybe in the month of April, before 30th, they achieve the target of 1 lakh. I will have to give this 20,000, and this 20,000 again, like I would have paid GST on 120, but I can still give credit for this 20 and reverse it because this is a discount out of the invoice, out of the original invoice given after the supply, but still this has a backup agreement entered into linked to specific invoice. I think I'm clear. So, and the input as is attributable to this discount again has to be reversed by the recipient. So when the government is giving you this benefit of, you cannot decide on the discount now, fair enough. You can actually give the discount after you achieve the specific target, or maybe you decide it later for great performance, etc. You can give this discount and say that your value of supply was net. So here also it is calculated only net. But you should also ensure that the other person has not taken credit on 120. He should take credit only on 1, meaning he has to reverse the input tax credit pertaining to this 20,000. So this is about the credit notes, equally applicable to debit notes as well. Kavin, can we move on to the next slide?
Shubha, there is one question from Moksham. One doubt,
Yeah.
if any item is given free with another product, how will it affect the GST collection? This is one question from Moksham.
Perfect, Moksham. That's a wonderful question. So if something is given free here, there is a impact on the other side. For the supplier, let's like we'll take the same example, 1 lakh worth of goods billable, 20,000 worth of goods free. Then again, I am collecting GST only on 1 lakh, which is paid by the customer. Customer will not pay the GST pertaining to this 20,000 because it is free. From my angle, I have given this 20,000 goods worth of 20,000 worth of goods free of charge to the customer. So this is basically my business promotion. In case if you are able to establish, here there are divergent views. In case if you are able to establish that this is only for your business promotion and this is in furtherance of your business, this is allowed. In case if this cannot be established, then you will have to reverse. You yourself have to reverse the input pertaining to this 20,000 rupees. Renuka ma'am can add if she has any specific experience in audit, because everywhere we are facing this concerns of this free. Their officers are taking divergent views.
There are two aspects with respect to distribution of free samples. See, with respect to free samples, see, the logic of GST, you have to understand one point is that if the government is going to get a revenue on the resultant tax, you are eligible for input. The government is not going to get any tax on the resultant output, then you are not eligible for input. That is the logic behind any of those things. Generally, with the introduction of GST earlier, take the case of this pharmaceutical industry, right? In case of pharmaceutical industry, how does the pharmaceutical industry operate? The medicines are distributed as free samples to the doctors. Okay, the doctor will recommend the particular medicine from the particular brand, and if you see that this particular medicine will be available only in the nearest shop to that particular clinic, because there will be an understanding that this particular pharmacy is going to promote only this particular company's medicines and which will be prescribed by the doctor nearby. So earlier, all these things were not considered, and in GST, free samples are also liable for GST. There is nothing free in GST, which you have to understand. As a business promotion, if you are able to prove that they have not used any input on distributing the free samples, that is fine. But with respect to the end use of free samples, per se, there is no tax. Then this applies for each industry. The concept of tax on free samples is different, and you cannot give a general opinion that all free samples are susceptible to GST or all free samples are not susceptible to GST.
Perfect. I think his doubt is clear now. So here again, the other points which you need to consider for the table for the outward supplies is commercial credit notes, accounting credit notes should not be reported, and outward supply subject to reverse charge need not be reported. That again, like we saw it in the table 4 itself, there was a caution note. Next slide, please. This table 4, when you are filling, just imagine a scenario where you are sitting in front of the GST officer, where you will have to explain from where these numbers came in, where you have either the invoice numbers, details, your sales tax, sales register, all these things should be intact for you to substantiate later that this supplies are legitimate B2C, B2B, zero rated, SEZ, in advance given and all these things. So your supply, this is a very, very crucial and important table, because this in any errors is equal to money. So as simple as that. So outward register. So have you come across something called as outward register? So in the tally or tally parlance or ERP parlance, like we can call this as our sales register. But when we say sales register, in case if there are exports without payment, nature of supply is different, and if there is bundling of activities, etc., we may not have details. But this is what is prescribed by the authorities, that you need to have the documents in place pertaining to all this. In case of taxable supply, you need to have a tax invoice. You need to have a bill of supply. You need to, bill of supply. Credit notes and debit notes cannot be oral. All your credit notes and debit notes need to be numbered. It has to fulfill those conditions. And you determine the type of supply. So whether there is a B2B or B2C, we already saw what the difference is and why it is important that this classification needs to be done mindfully. Export with without payment, SEZ supply with without payment. Again, here there is a difference because we have given LUT. You're not going to pay taxes. It's only an LUT. If you're paying taxes, then you'll have to take refund. And if there is no LUT, obviously government will ask for the revenue which belongs to it. So that way, that is important. And under whatever supplies you have made under RCM and deemed supply. So deemed supply is again like we saw in detail on what all will be your deemed supply. Nature of supply is like you will have to decide on whether you have to charge SGST or CGST or IGST. Where your why this is again is important is your place of supply. And as I told you, when you are collecting GST or remitting GST or raising an invoice, when you're determining the place of supply, you need to visualize India as a United States of India, because every state has a border in terms of revenue, in terms of the e-way bill, in terms of the movement of goods, etc. The government has eased out a lot of things, but for administrative convenience in a country like India, which has vast population, different cultures, some states are only like a recipient nature-based states, some states are manufacturing states. Given all these discrepancies, it is a state-based or state-based or probably like it is bifurcated into state borders for the state GST management. So identifying this is very, very important. And in case if you're bundling the activities as regular, composite or mixed supply, and determining the rate adopted. So when this bundling and determining the rate, again, bundling is like if you're using the supply as a regular supply, or the same example which I think Mokshan asked for. So when there is a mixed supply, when you buy paste, then there is a brush free. Just for understanding, we say like the paste is super luxurious paste and you're going to pay 28%, and a brush is 12%. Then which is the thing which you would adopt? It is the primary supply which you have to adopt for rate purposes. And here your primary supply is your paste, because you're buying the paste, you're not buying the paste for the brush. Many a times it would be otherwise, but we'll have to look at it from the sales point of view. They are not selling the brush, they are selling the paste. So that way the rate of the paste will be applicable, and the HSN is very, very important. So this levels of HSN again will be relating to your turnover, etc., which again we will be taking in the forthcoming slides. But this HSN is very, very critical, because even one digit change or one classification change, if there is a rate change from 12 to 18%, imagine that if we have been collecting GST at 12%, understanding that there is a that belongs to an incorrect HSN. But suddenly, like when there is a classification difference and the officer says like it belongs to this particular HSN, therefore like you will have to pay tax at 18%. So then it will become very, very costly, and obviously you cannot go back to your customer to say that, hey, come on, I did a mistake, I did a wrong classification whereby I collected only 12% from you. Now you have to pay me 18%. No customer will pay, because the customer will also have their own constraints in terms of taking inputs. Imagine a scenario where we are changing the HSN classification since 2017, because whatever is done is retrospective. So which customer will give, because this time of taking the input tax credit, he cannot alter all his books. Everything is gone, done and over. So you cannot change. So determining the rate is very, very important. And when you're putting this GST number, I mean HSN number in your GST returns, again be super careful. You can do a double check in terms of the GST registration, which HSN code you have registered, what activity the client is carrying on, and what HSN code you are giving here. It might occur that, you know, initially the client said, okay, I need registrations for these items. We did the registration. Then client wanted to add something to his business. He is adding, wonderful. There is a good turnover. Everything is happening. If you had missed adding this HSN into your registered transaction, I mean, as part of your registration amendments, then you cannot give this HSN there. It will not throw any error, but it will become a costly mistake later. Can we move on to the next slide? time of supply, again, this is crucial, where you are we skipping slides? So time of supply is like if you book a sale this month, imagine you are booking a sale in the March and you're reporting it in April. What happens? Then this becomes a transaction which you should have reported in your previous financial year and you're reporting in this financial year. And when I said you're reporting in April, I did not mean the GSTR 3B of March, which is filed in April. I meant the sales in April. So which means like the time of supply again is important. But why is this important? Because time of supply is there. Okay, fine. Now I have not concealed any information. I have not chosen an incorrect HSN, mixed supply, etc. is properly identified. Invoice is raised. Now, why is this time of supply very relevant here? I've identified everything and I paid the tax also to the government. Any answers? Any answers there? Kavin? Every time when I am asking a doubt, I am suddenly like wondering if I'm audible.
You are audible, ma'am. There is a latency will be there. No, from
Yeah. I understand the delay is the lag in
yeah.
because it's live in YouTube.
Just a second.
Yeah, sure.
Moksham is asking, can you please repeat the question?
Okay, so I told you like time of supply is important. So the factors to be considered when we discussed various factors on the documents to be prepared, the place of supply to be determined, because like a state managed GST, IGST, CGST is different and all that. Suppose in a case where I am taking care of everything, I'm identifying the mixed supply, I'm taking the higher rate, I am using the correct HSN, I have raised the invoice, I have paid the tax to the government. But I have missed considering this time of supply. So why is this relevant? The time of supply. If I made a sales in May, but I'm reporting it in September, but I've complied with all the conditions. So I've prepared a proper tax invoice with all the ingredients. Rate is correct, discount is correct, tax calculation is correct. I've reported it, I've paid tax. What is the impact? Why is the government sensitive about this time of supply, or why is it even relevant to consider the time of supply?
Mini Chandran has answered, Shubha.
Yes,
she says taxability arises on supply and on time of supply.
Okay, so we'll assume that he has given the correct answer. So the taxability arises on supply, and therefore the time of supply is relevant. Is a beautiful answer. Probably like he tried it, because we are typing. Obviously, it has to be short. So in the example which I said, where I made the supply in May and I'm paying the tax in September, where I'm considering the sale in September, technically I'll be paying the tax only in October. Imagine the lag. I should have ideally paid the tax in June, but I'm paying it in October. So the government is losing revenue for the intermediate 3 or 4 months, where it will ask for interest. So this time of supply again is very, very crucial. So there are cases where there are continuous supply, there are prescribed methods where you have to use or how you have to arrive at the time of supply, which is important. And in case if you come across something when you're finalizing your GSTR 9 in terms of the time of supply, which you should have reported in the earlier month and you reported in the month later, please make sure to calculate the interest and remit it. These are the finer changes or the finer details which you have to take care of. And of course, how you would report these interest, etc., which are paying this pertaining to the last year, you will have to definitely classify this as a prior period item depending on materiality, etc. But this has to be done. So I think we'll have to go to the previous slide. This is the adjustment, second part of the table 5. First part. So in table 4, we saw all the supplies. So B2B, B2C, export with tax, SCZ with the tax, and advances with the tax, and RCM payable on inward supplies. All that we saw that. So here, what are we going to see? So here you will be reporting the table 5. We have moved on to the next table, table 5, where we will be reporting the zero rated supply. What is a zero rated supply? Export. I told you why it is called zero rated. Without payment of. So this is the scenario where you have a letter of undertaking and you are making your exports. You will have to report it here. And supply to SEZ similarly without payment of tax. Here you have made a supply, you have not paid any tax and you report it. And supplies on which tax is to be paid by the recipient on reverse charge basis. If you recall, when we were doing table 4, we specifically spelled out that this is not pertaining to supplies made under reverse charge basis. There we are reporting only the imports made under reverse charge basis. Here it is supplies on which tax has to be paid by the recipient on reverse charge basis. Any idea why this is given in this table and the supply import is, I mean, whatever we have received for our services on reverse charge basis was given in table 4? Any logic? If it's reverse charge, they can put it in one place, like why headache, 2 different tables, 2 different reporting. This I have to remember that inward is there, outward is here and all this. Any logic why people have kept this, or it's just to complicate things?
Mini Chandran asked, does it include supply to SEZ?
Supplies on which taxes to be paid on reverse charge will not include SEZ, basically because any supplies made to the SEZ is exempt. It's equal to, its SEZ and exports are treated in par with each other. And the special economic zones are kind of, if you have to understand, this is a different country in our country. That is why the SEZ borders are there, the special economic zones, which is treated as a different country, and any supply made to SEZ will be treated like an export. So my question was different. I said like reverse charge basis. So when something is payable under reverse charge basis, in table 4, we said whatever we receive, we will pay and report in table 4. In table 5, we are saying whatever my recipient has to pay, I will report it here. My outward
answered,
yeah,
supplier will not pay the tax.
Okay, good one. So here you are reporting that there you reported what tax you have to pay. Table 4 is basically tax which we have to pay, all the forms of taxes, all the forms of supplies, advances, etc., on which we have to pay taxes. Table 5 is either exempt or someone else has to pay tax. Beautiful. That is the logic. That is why you say this is a supply on which I am not paying taxes, but someone else will pay the tax. That's why the supplies made under reverse charge are given in table 5. D is exempt. So what is exempt? Like certain things are exempt under GST, that will be reported here. And E is nil rated goods, and nil rated goods will be reported here. And F is non-GST supply. Now you might wonder like why we will have this non-GST supply, why we have to report this exempt supply, etc. So similarly, the reason is very, very simple, because your total supply, your total turnover in the income tax will not have these bifurcations of B2B, B2C, export with tax, without tax, or non-GST supply, etc. All these things should tie up with your turnover reported in income tax. And in GST and income tax, they have an information exchange, and I'm sure like last year itself, we beautifully saw the total turnover and input, whatever the client has taken is reflecting in the 26 years. That was effective, in fact, last year. So basis that your turnover should tally, and unless you mention all this, your turnover will not tally. That is one point. And you also have a liability to reverse your input tax credit pertaining to your exempt and non-taxable supplies, basically. Because as the Renuka ma'am beautifully said, she just did it bang on. She said if the government has to get revenue, it will allow input. The government is not getting revenue, it will not allow input. I think that is what we have to recall when we are doing this here. And that is why all these bifurcation is relevant. Can we move on to the second part of the table? Second part of the table is more similar to our second part of the table 4. Here you will have the credit notes, debit notes, supplies declared through amendments plus, reduced through amendments minus, and the same thing. And the credit note, debit notes will of course have the same conditions applicable, and it's just the same. So just the table 4, to summarize, table 4 will have all the transactions on which we have to pay tax on. There we are giving the number on which the government will calculate the tax, which has to be received from us. And the second part of table 4 will have all the adjustments, because we are reporting the gross number in the first part. Table 5, we will be reporting the turnover on which we have not paid taxes, and including the scenario of RCM where some other person will be paying taxes on our supply. And the second part is similar. We will report all the credit note, debit note adjustments. So we will arrive at a number on which we are not paying taxes. Can we move on to the next slide? So zero rated and SEZ. Zero rated exports and SEZ. As I told you, like SEZ and exports are the same, needs to be understood like SEZ is also pertaining to some other island, a country in our country itself, because that's why it is called a special economic zone. So here you have two options: with payment, without payment. And with payment we'll be reporting, with and without payment we are reporting in different tables, table 4 and 5 respectively. And this with and without payment is nothing but the LUT, the letter of undertaking, will make the difference. Next slide, please. Similarly, this LUT in detail, this of course, like all of you would have done. So this needs to be R&D level needs to be filed specifically to get this LUT. And a bond or bank guarantee is given in certain scenarios. In terms of goods, the money, the goods, it has to receive the money within 3 months. For services, it has to receive within 1 year of invoice. If it does not receive this money, then it is as good as you have not exported. Therefore, in case if you have given LUT, you have reported this in table 5. In case if you don't receive the money within 1 year, this will move to table 4, which will say that you will have to pay tax on this. So that is the idea. Next slide, please. So export goods, this is like the ancillary conditions which you have to check, because you are classifying the exports. You want to bifurcate into like whether you have to put it in table 4 or table 5. You need to verify these conditions. Export realization should be in convertible foreign exchange, because the very incentive the government is giving for all the exports is to promote the exports to realize, to receive a lot of foreign exchange into our country. And FEMA approved limit, there cannot be any violations of FEMA pertaining to this. And of course, the LUT and tax paid amount, whatever conditions are applicable, that is something which you have to check on. Next slide, please. No, the previous one, yeah. So table 5 of GSTR 9, RCM supplies to be reported separately in 5C. We saw that. Non-GST supplies is those supplies on which GST is, GST does not cover. That is like Schedule 3, totally away out of GST. Nil rated and exempt supplies has to be specifically reported as exempt or nil rated respectively. To understand all this, we need to know like which belongs to which category. And this, of course, relates to when I say like table 4 is directly money, table 5 is not like it's not directly money, it is also directly money, but it is pertaining to the input tax reversals, so on and so forth. But in total, table 4 and table 5 together should match with your turnover of your income tax and your ROC or any other financials which you are reporting. So with this, I think I will hand over the proceedings to Renuka ma'am. Ma'am, can you take over? So ma'am is going to give a lot of inputs pertaining to the inputs. She will say like what is eligible, what is not eligible, how you have to reverse which table you will have to show, and if there is any adjustments, how do you have to manage. So
thank you, Shubha. I'll just take over from there. So see, table 4 and 5, just apply the simple logic. Whenever you need to do a reconciliation statement or submit an annual return, you have to understand certain basic concepts. Technically speaking, the aggregate turnover, there's a definition called aggregate turnover. Aggregate turnover includes all the incomes in your in the credit side of your P&L account for your understanding. Normally, if you can imagine your credit side of a P&L account right now, you'll have buy sales, buy discounts, buy other incomes, everything will be on the credit side. So the turnover here does not mean only the actual sale of service or sale of goods or supply of service. It also includes all other income. So if you do not make any amendments, technically the total of table 4 and 5 should match with your financials, right? So once the turnover verification is completed, now we go to the input verification, which is going to be the lifeline of GST per se. So what do you mean by inputs? Inputs are things that you use for furtherance of business. So what do you use for furtherance of business? If you are a trader, you buy goods and sell goods. If you are a manufacturer, you buy raw material, you involve labor in that, raw material plus labor, then you add some your profit to it, and finally you manufacture something, you sell it in the market. So that will be your inputs. Supposing you are appointing staff. For staff, you spend money, that is your input. You rent a property for conducting your business. So that is an input service. So you can divide input into 3 categories: input of goods, input of services, and input on capital goods. Inputs per se mean the input of goods. Input services is, for your understanding, all the items appearing in the debit side of your profit and loss account. May it be printing and stationery, may it be postage and courier, may it be the water charges that you pay, may it be the salary that you pay, may it be the professional charges that you pay, anything that comes in the profit and loss account debit side or your input services, right? Anything that comes in your debit side of your trading account is input of goods, and anything that adds to the asset is called input of capital goods. Because you buy capital goods. What are the capital goods that we normally say? You buy plant and machinery for running your company. You buy vehicles for running your company. You buy computers for running your company. You buy furniture and fittings for your company. So all that you create as a capital good in your financials, in the balance sheet, becomes a capital goods, and input on that can be utilized. But can we use everything? Nothing is available for free in this world. Not only in the world, nothing is available for free in GST also. So when we say input, there are so many conditions to be followed with respect to input. And in table 6, 7, and 8 of GSTR 9, we are going to discuss how we are going to report all of them. Friends, please try to understand there are 3 types of inputs that are right now available to you. One is the input as per your books. Second one is input that you report in your 3B. Third one is input available in 2A. So let me just explain all these 3 and directly jump to the table 6. What is input available in books? Your profit and loss, trading and profit and loss account debit side. Just imagine for a moment. In trading account, you have 2 purchases, 2 carriage inwards. In profit and loss account, you have 2 salaries and wages, to bonus, to electricity bill, to telephone bill, to printing and stationery, to postage and courier, to staff welfare, to puja expenses, then repair and maintenance, vehicle insurance, stock insurance, depreciation. These are the few items that you normally report in the profit and loss account. So all these inputs of goods and input of services, when you are going to transact from a registered dealer, it comes with an impact of GST on it. May it be IGST if it is an interstate transaction, or CGST and SGST if it is an intrastate transaction. Everything comes with the input. So now you have an option to either use it as a cost or use it as an input. Why the difference? Because if you use it as an input for all practical purposes, this input of GST is a current item which is reported in the balance sheet as current asset. This current asset, so it doesn't form a part of your financials. A small example I will give and then we'll go to the table. Take the case of bank charges. How do you record the bank charges in the books of accounts? The bank statement is given to you by the client, right? Supposing you have applied for a checkbook issue. A checkbook costs 300 rupees normally. So 300 rupees checkbook issue charges will be there. Below that, there will be an 18% GST on that. So that comes to 54 rupees, right? So 300 plus 54, 354 rupees. So if you are writing an account, what you will do? You will just put 2 bank charges and put 354 rupees, right? What is the question here? 300 rupees is the cost of buying the checkbook. 54 rupees is the GST that you pay on that. So you are, as an accountant, you have to decide here whether to take 354 rupees to the P&L account or 300 to the P&L account and claim 54 as input. Here where all the differences will happen. Because you would have given your GST number to your banker. The banker would have given you the credit. By credit, he means he will report his sale of checkbooks to XYZ company, right? So he would have reported in GSTR 2A. You open the GSTR 2A and see Kotak Mahindra Bank, say 16/10/2022, taxable value 300. IGST, let us hypothetically, IGST 54 rupees will be there. Let us assume this is your 2A that is reported. What will happen to your audited financials? The accountant would have put 2 bank charges, 354 rupees. There is an input of 54 rupees which is available in 2A. Please be with me. Which is available in 2A, which you have not availed, even though it is eligible for you. Bank charges, the input is eligible for you. This will be one type of data that is available in 2A. Let us take another example. For the year, during the particular year, you have purchased a car, right? For the purpose of business, you have purchased a car. Let us say the car value is 10 lakh of rupees with a 28% GST. So 10 lakh 28,000 will be the total amount that you have paid on the car. So what would have happened? 10 lakh, you would have given your GST number to the car dealer. The car dealer would have reported this 2,80,000. I'm sorry, reported this 2,80,000 rupees in your GSTR 2A. What you would have done in the financials, you would have booked the vehicle as 10 lakh, 12 lakh 80,000. 10 lakhs plus 2 lakh 80,000. 12 lakh 80,000 vehicle you would have reported and you would have claimed depreciation on that. Also, if you are not aware of the rules of GST, this 2,80,000 is a huge sum of input, which also you would have claimed under 3B. All these problems to sort out only we are reporting in table 678 of GSTR 9, where we are going to bifurcate what is eligible, what is not eligible, what is availed, what is not availed, what is available but not eligible, what is eligible but not available. Everything will be discussed in table 6, 7 and 8 of GSTR 9. Once you are able to report them very clearly, it is easier for you to analyze the results, and accordingly you can determine the liability arising out of short payment in excess payment of excess claim of input. So your work starts with respect to preparation of GSTR 9 because the financials are already completed. What happens in the same example of bank charges? You have already declared 354 rupees as bank charges in the financials. You cannot take the 54 rupees out because it is already audited. So because if you take the 54 rupees to the input, your profit will come down by, your profit will increase by 54 rupees because you are removing the input of it. So you cannot touch the financials. You cannot touch the books of accounts. So if you have claimed the 54 rupees again in your 3B, that 54 rupees has to be reversed at the time of filing GSTR 9. So you have to analyze what is there in 2A separately, what is there in book separately, And how much amount have you claimed in 3B separately is what is the requirement of the day. Can we go to the next slide, please? Kavin, can you? Yeah. So, if you see here, now we can go to table 6. The very first item, table 6A, total amount of input tax credit availed through form GSTR 3B. This is an auto-populated data. You will not have any corrections on that. You cannot do anything about it. It's just the total of the inputs that you have reported. Every month, you report in table 4 of GSTR 3B, right? All other ITC, import ITC. These are the data that you report there. Everything gets added up and it gets reported here. It just says, okay, this X amount is the total of inputs that you have claimed. In table 6, you have to give the bifurcation. Out of the total input, how much belongs to input of capital goods, how much belongs to input of services, how much belongs to input of goods. So these three bifurcation you have to give here, and technically it is only the difference. See, supposing totally 15 lakhs is the input that you have claimed. 10 lakhs may be input on capital goods. 3 lakhs may be input of goods and 2 lakhs may be input of services. This bifurcation has to be given. And as far as GSTR 9 of financial year 22-23 is concerned, you have to report, let me repeat, you have to report input on capital goods separately only. You cannot combine it with anything else. But you can combine input and input services together, but input on capital goods have to be reported separately. So table 6B, you will report inward supplies other than imports and inwards liable to reverse charge. In table C, you will reply inward supplies received from unregistered person liable to reverse charge. Table D, you will report inward supply received from registered persons liable to reverse charge. So normally, the company who is giving transportation service, the company who are giving security services, all these will have an issue here when preparing 6. Otherwise, normally, for security services, you pay taxes under reverse charge. For transportation services also, reverse charge is liable. So, for general companies, you will not have much of a problem other than reporting the input of capital goods separately. The purpose of asking input of capital goods separately is to verify whether that particular capital good is eligible for, let me repeat, that particular capital good is eligible for input. The reason being, one small example I will give you. Supposing all of you will be working in a chartered accountant's office for your training purposes. Supposing the particular office is doing a complete makeover or doing an interior decoration for the entire office, putting false ceiling, putting centralized AC and all those stuff, right? Where will you book this data? Supposing your auditor has spent 5 lakh of rupees for a complete makeover of the of your company. By accounting standard, where will you book this data? Where will you show the data? I'm just waiting for an answer. The practical scenario. Where will you show the data? Or let me simplify the question. Or your principal chart accountant buys 10 computers for the office, right? All the computers are old, so he buys 10 computers for the office. Where will you show the data? So maybe there is an issue with the YouTube or anything. The answer comes. Mini Chandran says capitalize. Capitalize what? Now that we are running out of time, we are in table 6 and the time now is 5:46. If at all there is an answer or a query, Kavin, please you interfere and stop me, okay? Otherwise, we are just continuing all the tables. There are a hell a lot of tables to cover for the day. Okay, please listen. With respect to such transactions, what happens is you should know how to read the financial, how to understand the balance sheet. if there is a capital expenditure that has happened, in the example that I told you, if your principal auditor has capitalized these expenses and has increased the value of the asset, then in that case, you cannot claim input tax credit. But you have written off the entire expenses as repair and maintenance, then you are eligible for the credit. So you have to understand how it is to be done. So when there is immediately for the purpose of filling table 6, friends, we have to refer to the fixed asset schedule that is given along with the financials, because fixed asset schedule will give you the additions and deletions. If there are additions, find out on which asset there is an addition. If the addition is for vehicles, then you should not have claimed input tax credit on that, right? If it is an addition on building, then you should not have claimed input on that. So you have to refer. These are the back paper that you'll have to prepare for table 6 to differentiate between how much is on inputs, how much is on input on capital goods, how much is on input on services. Next slide, please. Now that having said that, 6 continues. Import of services, input tax credit received from ISD, amount of ITC reclaimed. This is one particular point that I will tell you. What is reclaiming? Procedurally, section 16, you have to refer to section 16 of the GST Act, where one of the condition of claiming input is that the creditor should be paid within 180 days of time. If we have not paid to the creditor 180 days of time, you have to reverse the input, right? And reclaim it at the time when you are going to pay the bill. Where will you get the data from? If you are if you are auditing for a private limited company, it's a CARO requirement, additional disclosures. There is debt available more than 6 months, less than 6 months, over a period of 3 years, split up is there. So if there is a sundry creditor lying in your financials for more than 6 months, this will have an impact on table 7, where you have to entirely reverse the credit since you have not paid the creditor. And if you had paid him after 8th month, then still you can reclaim it, which will appear in 6H. Transitional credit is already over, so let us not discuss anything here. 6M. Any other ITC not specified above. When we started this particular session, I told you that you have to refer to the GSTR 9 of the previous year. Friends, please be careful, be with me. In GSTR 9, now we are going to do GSTR 9 for the financial year 22-23. In the beginning of the session, I told you keep GSTR 9 of 21-22. In GSTR 9 of 21-22, in table 8C, you would have reported input of 21-22 reported in 22-23, right? The input will be available in 21-22 2A. Your invoices would not have come, so you would have booked in the financial year 22-23. That data will have to be reported in 6M. That is why I told you keep the GSTR 9 of the previous month ready. So all these columns you have to be very careful in filling, because this will amount to reversal at any moment of time. Next slide, please. Now coming to table 7 of GSTR 9. Table 7 of GSTR 9, you will report all the possible reversals. Okay. Now we are in the financial year ITC of 22-23. What will happen? ITC not taken. The time limit for claiming the ITC for the financial year 22-23 is 30th November 23. We are in 3rd November. So that means if you have not claimed any ITC pertaining to 22-23, you can report it in the 3B. When you file on November 20th, you will be filing the 3B of October 2023. In that 3B, you can claim all the possible inputs. Why November 30th? You can file it belatedly for 10 days. That's all. So if you are not going to take, this is the time. If you are not going to take input for 22-23 in the October month return, then the entire ITC gets lapsed. You cannot claim it at all. Then ITC claimed in 22-23 will be reported in table 13. ITC not reversed will be reported in table 7, against which you have to pay through DRC 03. That we'll see when we come to the payment part of it. Any ITC reversed in 23-24 will be reported in table 12, which we'll see it in further in the upcoming data. Next, please. Next slide, please. Is there a problem?
Yeah.
So all the reversals will be appearing in table 7. So remember, table 6 is for reporting the bifurcation of inputs as input of capital goods, input of services, reverse charge input, reverse charge capital goods, reverse charge service. It is only for bifurcation. You don't do anything else there. In table 7, you report all the reversals you have made. Rule 37 for non-payment of the supplier within 180 days, which I told you. Rule 39 due to ISD, ineligible ITC receipt from ISD. ISD is slightly complicated topic. I don't want you to get confused with that. So we'll skip for today's session. Maybe on another session we'll discuss about ISD. But for general understanding, ISD means input service distributor. When the head office is going to do a bulk purchase for the entire country as such, it has to distribute the input. Say, take the case of Indian Overseas Bank is a bank which is spread across the country where it is having the head office in Chennai, right? All the checkbooks will have the IOB logo. All the checkbooks will be duly numbered. So what happens is these checkbooks will be distributed depending upon the requirement of the state in each customer. So all these things will be, all these input for printing the checkbooks, right, will be taken by the head office. And depending upon the value of checkbooks that is distributed to each state, the head office and IOB will distribute the input to each state. This is what is called input service distribution service, for which you have to take a separate registration and distribute. Let us not go into all that complications. On a day-to-day basis, you do not get any of these transactions, but if at all you get it, if you are doing an audit of a company who has an IST registration, you have to be very careful in deciding what is the eligible ITC in such case. Next slide, please. 42 and 43 reversal is just for ITC on personal use, ITC on exempt supplies, ITC on proportionate reversal. There was a question that was raised during table 4 and table 5 about free supplies. ITC on exempt supplies here. If you are going to give a free sample, if there is an exempt supply, the resultant ITC has to be reversed as per rule 42 and 43. There is something called a T1, T2 rule. Rule 42 and 43, if you study, they're slightly complicated. But still, as a part of GSTR 9 preparation, you have to understand what rule 42, 43 is. Where, say, in case of capital goods, you use a proportionate reversal of 25% every month, every quarter. You'll have to allot some points and reduce the capital goods and reduce the input claimed on capital goods and then sell the capital goods. There are a set of rules that we'll have to follow, but for common understanding, please remember ITC on personal use, ITC on exempt supplies, ITC on proportionate reversal. A small example, let me tell you, there is a doctor who is filing the returns regularly. The doctor has got two incomes. One income is from rendering health services. The second income is from letting out of house property for commercial purposes. Letting out property for commercial purposes, this doctor is liable to GST, whereas for health services, she is not liable to GST. Let us hypothetically assume that the total turnover of this particular doctor is, say, 3 crores of rupees. She gets 1 crore from renting services and 2 crore from health services. Okay. So what happens? This 2 crores is exempt supply. Health services is exempt, whereby 1 crore is liable to GST, for which this doctor is paying GST on health services. So what happens? Say, for example, I am their chartered accountant. Okay. I am charging 1 lakh of rupees as audit fees. Right? Since this doctor is registered under GST, for renting services, I will raise a GST bill as a B2B GST. I will raise a bill for 1 lakh with charging a 9% CGST and 9% SGST. Remember, friends, this 1 lakh of rupees that I am charging for her to audit her books of accounts includes exempt health services and also taxable rent services. So what happens? I have to proportionately, the doctor has to proportionately reverse. She cannot claim the entire 18,000 rupees as input, because this 18,000 input also includes ITC that is eligible for exempt supply, which is health services. This is where rule 42 and 43 play a major role. So you should understand when you have to reverse, and if at all you have not done, GSTR 9 is the right time to do the reversal. Next slide, please. Section 17.5, blocked credit reversals. Everywhere in every session, you should have understood, and this will be a prominent question for your CA exam also. 17.5 is a very important section that you have to remember. Section 17, subsection 5 talks about the blocked credits, right? Food and beverage expenses. Supposing there is a staff welfare item in your profit and loss account. So as a prudent article to student of CA, you go into the tally, find out what is there. So the your company, your audit office has celebrated 25 years of service, right? They booked a hotel, they booked a hall in Park Sheraton, and you celebrated the anniversary. For the anniversary, you have spent, say, around 1 lakh of rupees you have spent. Okay, so this will be the blocked credit because the money spent on food and beverages cannot be claimed as input. And if we had claimed it, it is liable for reversal at the time of GSTR 9. Next, please. Other reversals, it will be reduced from the claimed 3B for, see the problem with, can you just go to the next slide, please? Still next slide. Next slide. Okay, stop it right here. When I come to the table, I will tell you. So you have to understand the whole concept of ITC. The first one is eligible ITC under section 16. It should not have been blocked. You should not reverse it. Only the total will go to ITC available in returns. There is something called availed and utilized. What is availed? What is reported in 3B is availed. You do a set off rate for payment, then only the term utilized will come. There is a huge difference between availment and utilization. Availment is just reporting your inputs to 3B. Utilization means, remember the electronic credit ledger. As and when you report adding your ITC, your electronic credit ledger balance will increase, right? When you do a reversal, the electronic credit ledger balance will come down. When you utilize for payment of your liability, the electronic credit ledger will come down. So just remember as how you deposit money in bank, the value increases. When you withdraw money, the value decreases. The same way in electronic credit ledger, when you deposit the input tax through 3B, your electronic credit ledger balance will increase. When you withdraw that for the purpose of utilizing to payment of liability, the credit ledger will come down. Friends, let me tell you, in a genuine situation, your closing balance of input tax credit in your financials should match with the closing balance of input tax credit in the electronic credit ledger. If you are able to do that, then you are a perfect accountant. Please proceed. Annual return table 8. Right, great. This is where we are talking about utilization and availment. 2A, what is 2A? 2A tells you the entire input that you receive from multivarious suppliers. Okay, the entire input. It doesn't see whether you are eligible, whether you are not eligible, whether it is wrong, whether it is correct. Nothing will be looked there. The entire GSTR 2A will tell you the amount of input that you receive from various persons. Remember, what is eligible may not be available. What is available may not be eligible. Whenever you read your 2A, you have to read this. This is, I would say, this is a slogan that you have to remember as far as GSTR 2A is concerned, because there are 500 line items of GSTR 2A which is there. You are very happy. You have got 10 lakh of input. You don't have to pay the liability. Friends, let me tell you, very sorry. Not everything that is available in 2A is eligible. You have to understand whether you are eligible to take that particular credit. Next slide, please. GSTR 2A credit notes. Next slide. When the credit notes in GSTR 2A, when there is a component of GST involved, then remember you have to reverse it in your 3B. If you have not done, GSTR 9 is the best time. If the credit notes do not have any GST component, reversal is not required. Next slide, please. Next slide. Great. Here, ITC as per GSTR 2A financial 22-23. With respect to input, how do you start your GSTR 9 and 9C working? First step, please download GSTR 2A for the entire financial year 22-23. Step 1. Step 2, you create a remarks column in the Excel sheet, because all of us use with Excel. You create a remarks column in the Excel sheet and decide whether it is available in books or not, right? If it is available in books, step 3, whether you have claimed it in your 3B. So all these 3 will be one particular cycle where, okay, this is eligible. What is the second step? Let us assume in 2A, there is an input that is available, but you have not booked it in the books. The reason being, 31st March, the other party would have reported it. You would not have received the bill. So what happens? This is called input of 22-23, available, but not claimed in 3B. So where you can claim it, you would have reported in the current year, 23-24, you would have booked. This you will report in table 8C. If you go to table, can we just go to the table, please? We have the tables here. Kavin, can you just go to the table?
Previously, ma'am.
Yes. Not the previous slide, the next slide.
Okay.
Yeah, slide number 34 probably. Yeah. See, 7 I have already explained to them. We can just skip. Go to the next table. Next one. Stop right there. If you see here, friends, ITC as per GSTR 2A is auto-populated. You don't have anything to do. ITC as per sum total of 6B to 6H. That is also from the table 6, we have already said you do not have to do. I am talking 8C. This is where you have to remember very correctly. ITC on inward supplies, which you can report it here. ITC of 22-23 of 2A reported in 23-24 should be reported in 8C, right? Because this you will be keep it as a reference and report it in table 7 of the table 6 of the next year. ITC available but not availed. Why you have not availed? Like this example that I told you in 354 rupees. 54 rupees is the GST on bank charges. You have not availed because you have booked it as a cost, which will be reported in 8F. ITC available but ineligible. As I told you, if you have capitalized the amount, if you have purchased a vehicle in the example of 10 lakhs plus 2,80,000, 2,80,000 is available but ineligible. That will be reported here. IGST paid on import of goods. You have to refer the bill of entry very clearly. And if the bill of entry consists of that IGST, that will be reported here. ITC available but not availed on import of goods, that also will be reported. And friends, let me tell you, normally any balance that is arising gets lapsed to the government. That is what is table 8 is all about. Table 6, 7 and 8, they play a major role in deciding your inputs, and you have a lot of work here to do. Genuine work, because you cannot alter the financials, you cannot alter 2A. What you can do is reconciliation. A clear reconciliation is required. Two types of reconciliations you will do. One reconciliation is with respect to ITC for 2A, that is ITC available in 2A of 22-23, add ITC of 21-22 claimed in 22-23, less ITC of 22-23 claimed in 23-24. That will be the net available ITC for the purpose of GSTR 3B. With that figure, if you are able to do the reconciliation, if you do the correct reconciliation, there will be only nil difference between your 3B and 2A. So this I hand over the proceedings to Shubha to continue further.
Yeah, thanks, ma'am. I think ma'am was very, very detailed enough in giving you an insight on the inputs completely. So now we will move on to the summary, probably like the tax payable flows from table 4N. This is all like the technical information. So can we move on to the next slide? So this is basically like auto populated, where you will have to adjust. Like for reversals, it has to be adjusted, and all this, your reconciliation is the mother, which is very, very important. You need to have a clear number of input which you have taken. So when the tax payable flows from 4N, after adjusting the considering your supplies, adjustments, inputs, etc., this should match exactly with the workings you have. Next slide, please. So this is transactions in current year, payment in next financial year. How does this occur? So in case like when we are filing the GST returns, so GSTR 1 and 3B, like we keep filing, and maybe like at the end of the financial year, we understand that we have not accounted for one particular invoice. And you would have, of course, discovered all this by now when finalizing the financials, reporting it in income tax, etc. So now all what you have to do is, or maybe like you have adjusted the same thing when you have reported this in the current financial year and you have paid taxes. So what are these adjustments? So here, paid in 3B of 22-23, where you will have to report, like your table 4 contains the entire thing. So table 4 you have not reported. Now you have reported in the current financial year, and obviously when you're reporting in the current financial year, you will pay the amount via DRC 03, which is the other payments when not set off just like against your normal transactions is the extra tax which you are paying for pertaining to the previous year, your interest, etc. And table 10 we already saw, which is like your table 4, 5 and other tables are pertaining to the current year. Table 10 to 13 pertains to the previous year transactions reported now. So in case if all these things are not paid at all, so you've discovered something which you have not paid, then that comes from the table 4. Yeah. Next slide, please. So here, this again like table 10 and 11 of GSTR 9 amendments for output. So we have already done our amendments given in the part 2 of table 4 and 5, and this data flows from that portion to the table 10 and 11. And obviously 12 and 13 are like amendments pertaining to the input. So 4 and 5 was pertaining to the supply. Then later like 6, 7, 8 was pertaining to the input. Now we are moving on to the 10 and 11 where we are reporting the transaction sales again, sales pertaining to the previous year, and 12 and 13 are pertaining to the input which you have taken. So in case if there is any amendment, etc., then you have to report this here. And table 14, obviously the summary, the differential tax paid for this. The extra sales which is reported, which you have not reported during the financial year, the difference input which you have taken, which you have not taken in the previous year, or any other amendment, so on and so forth. Then the differential tax which you have paid pertaining to this. Next slide, please. No, the previous one. Yeah. So the book turnover of 22-23 is table 4. And so we just saw that all the data which you gave, like which is flowing from there. So your total sales per se, your taxable turnover should be like from table 4, your table 10 and 11. This is only your taxable, like where the tax liability comes in. So your total liability will be like table 9 and table 14, where you have all the total of your inputs taken, your adjustments made, and the inputs or the liability on the incremental sales which is not reported. Next one. So table 15 is on the refunds, and table 16 is on the other information, which is the other demands, etc. So in case if you have claimed any refunds which you have taken, and if the refunds are issued, and refunds could be in the cases where you have paid incorrect taxes, it could be in cases where you are doing like exports, it could be a cases where you have paid extra taxes which is not warranted for. In any other cases, like whatever refund you have claimed, that will come in table 15, and any other information. Next slide, please. So that option not to report is like coming very slowly, because again, it is good to report, because whenever a GST audit comes in, where you have to explain things in terms of your adjustment input, input reversals, etc., this refund becomes very, very crucial. So it's better to report, though it is not mandatory. And in terms of the HSN, again, like you have outward supplies pertaining HSN, and table 18 is inward supplies pertaining HSN. Of course, above 5 crores, you will have to report up to 4 digits. And I mean, up to 5 crores, 4 digits, and above 5 crores, you have to report 6 digits. And this is where I told you, you need to be very, very careful when you're reporting this HSN. This should be part of your registered transaction. And table 18 will be your inward supplies HSN, nothing but your clause 44 with your HSN. Next one. So this is analysis of GSTR 9. So where you have the tax paid as declared in the returns filed during the financial year. This is nothing but your summary of your GSTR 1 and 3B. So in this 4N, we just saw that this is a summary of all the turnover which you have reported in GSTR 9 and the tax paid as per 3B. And whatever difference, how you have actually paid, in case if you have not paid through DRC 03, etc., this has to be paid. So this is the crux, this is the summary, and this is the table which the government is most interested in. Next slide, please. So this is like particulars of the transactions of the previous financial year declared in the current financial year. I think we discussed enough on this table 10. In case if there is any doubts, we'll be happy to take. And this is the other information pertaining to the refund and demand, of course, demands and refunds. Next slide, please. So this is the HSN page. This is more like, just to get you, you get a feel of what you have to report. The HSN code, the quantity and all that. Yeah, it's self-explanatory. Move on to the next. Export register. So like after table 4 and 5, we saw like you'll have to have something called as an outward register. This is specifically a export register where you have to maintain all these records of what has to be, because there we saw it has to come in foreign exchange, there should not be FEMA violation, etc. So for that, you will have to maintain a separate register. Tomorrow there is any queries from the FEMA or RBI, and all of you as practice, you would have encountered scenarios where like unless you give the invoice, monies cannot step into the Indian territory. So for your client to get the money, they will definitely give the invoice numbers to the bank. And of course, many of you would be doing the STPI returns as well. So that way you will better understand this. And export register is definitely a mandatory book. And as the Vadivel picture says, we should really wonder whether this is there with our clients, but this has to be there is the fact. Yeah. Next slide, please. We'll move on to the GSTR 9C. I would hand over the proceedings to Renuka ma'am to do the first half of it.
See, what is GSTR 9C? GSTR 9C is a reconciliation statement which tells you why there is a difference between your books and the GSTR 9. It's very simple. So once you have prepared GSTR 9 without any hassle, GSTR 9 is only, 9C is only recommendatory in nature. Say for example, your turnover as per books is 10 lakh of rupees. In GSTR 9, after making all the additions, deletions, subtraction, your turnover is 9 lakh of rupees. Here, you just report why there is a reason for difference, why there is a difference of 1 lakh. Normally, if you prepare GSTR 9 properly, applying all the principles that you have discussed in the over 2.5 hours of discussion that we had, now the time is 6:14. So 2 hours 15 minutes we have discussed in 9. You should be wondering if it is 9 and 9C, why this much of time for GSTR 9 and only 40 minutes for GSTR 9C. Friends, let me tell you, if you prepare GSTR 9 without much of a hassle and a problem, preparing 9C is just a left-hand job. You have to just say everything is nil, everything is matching. Your input is matching with your books. The input claimed in GSTR 9 is matching with your input in books. Your turnover reported in GSTR 9 is matching with your books. Your tax liability that you paid in your books is matching with the tax liability that you paid in GSTR 9, because the liability, differential liability that is arising due to the difference between the books and the returns will be paid through DRC 03, and once you pay it, that means you have paid the entire liability of GST for the financial year 22-23 and you'll have nothing to report. With respect to GSTR 9C, table 5B to table N, the option to report, optional reporting continues. That means it is not mandatory report. All the table have an option not to fill this table. If there are any adjustment required to be reported, then the same may be reported in table 5O. So what is table 5O? With respect to movement sale of vehicle, the GST is payable only when the only on the difference between the return down value and the sale value. When the difference is negative, you don't report. So technically, if you sell a vehicle for 5 lakhs, okay, in the books, the return down value is 3 lakhs. You pay GST only on the 2 lakhs, okay. But whereas the sale of asset will be reported at 5 lakhs. Such intricate data has to be reported in table 5O, except that there is no change. Then GSTR 9C, 12B and 12C. 12B, any ITC which was booked in the audited financial statement of earlier financial year, but availed in the ITC ledger in the financial year for which the reconciliation statement is being filed for shall be declared here. Your 12B and 12C has been made mandatory. It should have to match with the GSTR 9 data that you have already reported. Okay, that is very, very important, because in GSTR 9 we tend to match the data available in GSTR 2A with the data available in books. In GSTR 9C we report what is reported in the books, what has been claimed, and what is yet to be claimed. Okay. It is something like the opening stock, closing stock, purchases made during the year, sales made in the year. It also gives the ITC as per the opening balance, ITC added during the year, ITC availed in 3B, and the closing ITC. Technically, this data has to match perfectly. There should not be any such differences. So this is a very important table. And if there is a mismatch between this table 12B and 12C with GSTR 9, you may expect a report, expect a notice from the authorities on any date. Next, GSTR 9C of table 14, the optional reporting continues. If you just have, if you are able to see GSTR 9C, you will always see that you have to in detail report the entire inputs. How much is received on purchases, how much is received on other expenses, how much input is spent, how much input is on capital goods, like this. The detailed expenses have to be reported in table 12 and table 14. I would suggest that even though it is optional, it is better that we fill all the tables of GSTR 9C, so that tomorrow whenever there is a report or whenever there is a notice, what will happen is the audit working paper play a major role for 9C. You might have completed your articles and you might have left the firm, or the person who did the 9C 3 years back would have left now. You might be the new audit assistants in the firm. Then you will be just breaking your head now because there was no working paper which was able to tell you what is to be reported and what is not to be reported. So when you leave the chartered accountant office completing your 3 years of articleship, and when some another batch of students come and they take over, when they open the book, see that some data is available to them for verification, because these working papers are continuous in nature. Okay, so this table is for reconciling the ITC declared in the annual return against the expenses booked in the audited annual financial statements of books of accounts. Next one is turnover as per financial statements for the GSTR 9. Turnover as per GSTR. This is the reconciliation that I was talking about. Technically, after completing GSTR 9, there should not be any balance that is pending as far as table 5 is concerned. If at all there is pending, if you see after every table, there will be a response table where you have to give your queries and explanations. If there is a difference that you think you should report, don't write nil. Please give your detailed explanations in the differences as the case may be. Table 7 is, as I told you, taxable turnover as per financial statement for GSTN and taxable turnover as per 9. Then you do the reconciliation, right? This is table 9 talks about the rate-wise liability. How much is the rate of 5%? What is the tax liability? 12. What is the tax liability? 18, 28, 3. There is one column here where I would just want to spend some time. There is a column called interest, late fee, penalty, and others. See, if you are doing a DRC, if you are doing a reversal and you are paying in DRC 03 for input reversal, you can report it in the others column, so that your total amount to be paid as per the tables will be the data as per the books culled out, and amount paid as per GST return will be the data in table Q. So P minus Q should be nil. That should be the way in which you will match the rate-wise liability. So now I'll hand over to Shubha to complete 9C.
Thank you, ma'am. So can we move on to the next slide? So table 12, ITC reconciliation, as ma'am told you like in the intro, as if you have done your GSTR 9 in detail, then all these things are, you'll have to just put nil and move on. But just for the benefit of you, for you to understand this table, I'll just explain. So this is ITC availed. So ma'am explained very clearly as to what is availed and like what you have actually utilized. So this is availed as per audited financial statements for, this is like every GSTN units wise, and this is ITC in the earlier financial year claimed in the current financial year. Similarly, the vice versa. So you have not claimed, but you have booked, you will be claiming it in the next financial year. And this ITC availed as per audited financial statements or books of accounts, again this will be auto-populated, and the total ITC claimed in your GSTR 9. If all this is matching. Basically, you would have done this matching of your ITC reconciliation, which is core crux of the entire GSTR 9 and 9C, probably after calculating the liability. If you have done your books, if you have done your ITC calculation, if your books and ITC workings which you have done independently is matching with your input taken in 3B and your GSTR 9, then this is a very, very simple table where you will have to just report the numbers which will have all the data for. Next slide, please. So this is reconciliation of ITC declared in GSTR 9 with what you have availed as per expenses in your audited financial statements, nothing but your clause 44. Now that you have already done your clause 44, you would have taken your expenses which you have done with registered people and unregistered people, and whatever expenses you have done with registered entities, you would have bifurcated that again with your eligible and ineligible, as ma'am said, like when you given the columns, you will have to first check like whether it is available in your 2A, 2B respectively. And next is like whether you have taken credit in your books, whether it is eligible, whether you have availed, which month you have availed, which month credit. So if once you have this table in hand, then this is very, very simple. You'll have to just bifurcate it into, for example, your purchases, total amount of ITC, and in this like eligible ITC availed. So this out of this ITC, what is not eligible, we are not reporting here specifically. We are only saying the value of the goods or services availed by us, then total amount of ITC. Out of that total amount of ITC, it should be like eligible and availed. So that is the column 4. Can we move on to the next slide? So, no, the previous one, yeah. So this is a live example, a problem where you will generally face. We just wanted to take you through a kind of assignment, if I may say so. So this is the if you are just preparing a normal P&L type of a thing from a very small business perspective, but of course we have covered all the adjustments possible which you can apply even for a larger entity. So the first thing is rate-wise bifurcation of sales. And this rate-wise bifurcation of sales, you will anyway have it in your Tally or ERP or whatever systems you have. And you will report that this turnover should, of course, match with your table 4 and 5 put together with all the adjustments. And then you have the rate-wise purchases. These rate-wise purchases will be important for you to prepare the input tax input register, where you will have the total amount of amount spent, the rates, and at which you have paid the GST, whether you have paid it within the due date, whether it is eligible, whether you have availed all these information, and then you arrive at your gross profit. So this is a trading account basically. So then you take the gross profit and you have a other income portion. When you are reporting this other income portion, it is important that you understand whether this other income is again like a GSTable supply or a non-GSTable supply. So if it is a GSTable transaction, then again the particular rate wherever like you have collected GST, etc., has to be reported. If it is an interest kind of a transaction where it is like a non-GST transaction, it is okay if you just report it. Of course, this reporting will also tantamount to your, you'll have to report it in your corresponding tables in your GSTR 9 and 9C. Then you have all the expenses. So as far as, previous slide. Previous slide, please. Yeah. So here you have the EB, which of course, like we don't pay any GST on EB, non-GSTable transaction, that you can put it together. Suppose your bank charges, you are putting this as 118. You should have ideally taken this as 118 should be your should go to your credit ledger, and from there you bifurcate this into whether this is eligible, ineligible. Then you take the input. What happens if you just debit the entire 118 here and also avail this 18 rupees credit? Then you have to reverse your 18 rupees credit, because this, or at least like adjust your expenses here, because you cannot take both the benefits of claiming the expenditure and also taking your GST input tax credit. Similarly, for staff welfare, if you have taken this entire GST credit, then this credit is not eligible, as ma'am said, like if it is pertaining to a annual event or a celebration, the food and beverage, etc., then this is not a eligible thing to be claimed. As far as depreciation is concerned, of course, we will check whether this is capitalized or whether we have chosen to take the depreciation and then we arrive at the net profit. And this is how your balance sheet will look at all your furniture, and you have other information. Then all your input CGST, IGST, and SGST, whatever you have accumulated. So this input which you have claimed in as assets should be the eligible GST which is available. So only this particular thing can come into your assets. Rest all the input should ideally go into your debit side of your P&L. If not, it will only lapse, as ma'am said. So here, if you are putting some number here in your balance sheet, this should be your eligible available input tax credit. So, and this is of course your output liability, whatever you are supposed to pay. Yeah, next one. Ma'am, you can add if I'm missing something here, because this is basically her proprietary thing problem. She has worked out this for very clear understanding of yours. So, yeah, the next one is the journal entries. Yeah, previous slide, please. So here, these are basically the journal entries as to how you have to account. Because these purchases, it has gone into the input tax register, CGST and SGST respectively, and IGST respectively. Vehicle repair has gone here, and vehicle repair, you need to check whether it falls under those eligible categories. If it is not so, then you will have to remove this as an ineligible item. Bank charges, if you look at the entry, this 18 rupees should ideally gone into the SGST and CGST respectively. So 9 and 9. So the entry should have been like bank charges debit 100 and CGST, SGST 9 and 9 respectively to bank. Furniture and fittings, similarly, it has gone properly duly into the input account. Therefore, like I'm eligible to claim my input, and I should not claim depreciation on this 53,000. I should be claiming depreciation only on the 50,000. Similarly, for courier, etc., the total overall amount is expense debit to cash. So this case, again, if you note, all the staff welfare and printing and stationery courier charges, there is a GST. This again is an incorrect entry where you have to debit courier charges, SGST, CGST, and then your party. And in case of staff welfare, it is the same thing. When all this composite entry is going to cash directly, irrespective of the fact that I have a courier charges, etc., my input will not be eligible. So here is the correct. Yeah, next.
Sorry to interrupt, Shubha. Just to add on to whatever Shubha is telling, friends, see, at the beginning of your learning process of accounting, and even in the tax audit time, in tax audit, you have one question. Do you maintain, what system of accounting do you maintain? Either you click on mercantile or you click on cash. Friends, let me tell you, with respect to GST, it is always the mercantile system. Only if you maintain the mercantile system of accounting will you be able to do the process. Like as one example, like what Shubha, if you see the last journal entry here, you have booked it as courier charges to cash 180 rupees. Okay. Now I'll go to the next slide. This is your imaginary 2A. Professional courier would have given 9 rupees, 9 rupees. Right? This supplier will not be available in your books at all because you have booked it again cash. So remember, you have to follow mercantile system of accounting, whatever type of software that you follow. So your actual entry, only if your actual entry had been courier charges accounted are 100, CGST 9, SGST 9 to professional courier. Then from professional courier to cash, if you had passed these two entries, then your ITC is eligible. If you say courier to cash, you put 180 and you claim the 9 rupees as professional courier, then your ITC is to be reversed because the tax invoice and the books of accounts is a basic data for complaining your ITC. So this is where you should know how to maintain the books of accounts. Remember, if you are going to use tally, the word says whenever there is a debit, you give a credit, it is fine. But in GST, when you verify, you have to see whether the debit is the correct debit and the credit is the correct credit. Shubha, continue, Shubha.
Yes, ma'am. Thank you, ma'am. So moving on to the next slide. Interest. So this is a very, very interesting topic as such in GST. Because when we are encountering a lot of audit, etc., left, right, and center interest is levied. And as we discussed earlier in the session, any time of supply related issues, immediately any input which you have availed incorrectly, interest kicks in. Any input, etc., which you have to be reversed is not reversed, interest kicks in. So there are like wherever there is a revenue leakage for the government, the interest kicks in. But here particularly there was a huge dispute pertaining to on what this interest has to be calculated. So this after a large debate, it came to a scenario where the interest will be calculated only on net amount, cash payable. All input is an amount which is already there with the government. So therefore, interest will not be calculated on that. For the benefit, like provided that interest on tax payable in respect of supplies made during a tax period and declared in tax return for the said period, furnished after the due date, in accordance with the provisions of 39. Basically, like you can file your return only when you make the payment. So here you have furnished the return after the due date, which only means that you have made the payment also after the due date, except where such return is furnished after the commencement of any proceedings under section 73-74, shall be payable on that portion of the tax which is payable by debiting the cash ledger. So this is like what is 73-74. This is like I realize voluntary compliance. I realize that I have to declare this particular supply. I realize that I have missed reporting the supply. I realize that I've taken an ineligible input. I realize that I should have reversed the input. All this I myself realize and I voluntarily do. Then all the interest I have to pay is only on the cash. Let's say like if I am input rich, I have like super duper input maybe for the next 3 or 4 years, for whatever reasons. Then that case, this particular interest portion will never kick in, because even if I reverse whatever I have to do, my input will still be available. Therefore, interest is not applicable. In case if I have a scenario where I'll have to pay 1 lakh rupees, I've paid 90,000 from my input tax register and only 10,000 I'll have to pay in cash. And I did not pay anything because that time, without considering the sales underreported or input, etc., my liability was only 90,000. I debited the input register and I paid. Now, after calculating and correcting the entire scenario, if there is a 10,000 payable, then interest is payable only on 10,000 rupees and not anything more. That is the idea. And this is retrospective effect from 2017. And this luxury is not available if the department finds it out. So if they start a proceeding under section 73 or 74, then this luxury is not available. Then you will have to pay interest on the entire amount, basically because your intention is not to disclose. If it is voluntary, you get this benefit. Next slide, please. Now you might wonder, like I'm talking about the proceedings officer, etc. Why is this even relevant for 9 and 9C? 9 and 9C, when you are doing the reconciliation, these are the intricate items which are relevant, which you have to look into now. Because as we discussed in detail, like nothing can be changed after completing the audited financials and filing our income tax returns. But still, if you have missed, reversing an input, or reporting in a different time zone on which interest is applicable, etc., you will have to definitely do so with the risk that you will have to report this as a prior period item, depending on the materiality. Next slide, please. Interest on net liability. This is exactly what we discussed in detail now. So if it is voluntary, it is net. If it is initiated by the department, it is gross. So this is where it is important that ma'am was clearly explaining on what is availed and utilized. So in case if you have a ITC wrongly availed and utilized, you will be paying an interest of 18% again when it is voluntary. Then in case if you have a ITC wrongly availed, but you have not utilized, then there is no interest which is payable. Just the scenario which I mentioned as scenario 1, where you have abundance of input and you just claim something incorrectly, you want to reverse. Even after reversing that, you still have input, then no interest is payable. That case, interest is availed, and ITC is availed, not utilized. Yeah, next one. Yeah, this is that scenario where I explained of that 1,90,000 liability and that 10,000 interest will be payable only on the 10,000. In case if you wrongly availed ITC, if the return is earlier the due date of, if you're filing it within the due date, then whichever date you are filing the return. If it is otherwise, wherever this becomes eligible in your electronic credit ledger. Next slide, please. So that's it from us on the 9 and 9C. Probably like we'll open the floor for questions. Ma'am, as they post some questions, probably like can you share some your experience in audit when you're facing the GST audit, where this particular reporting under GSTR 9 and 9C, where this input, etc. are reported, where you find this totally difficult or challenging to convince the assessing officer in terms of the numbers which we have filed. Because we have seen cases where they just download GSTR 9 and 9C are the most easiest one, because after filing GSTR 9 and 1 and 3B, you can just download a auto-populated 9 and 9C, where it is so easy for people to assume that it is all filled. Just like our ITR, income from other sources, it is so easy for me to assume that everything is filled and just upload it. Is it really so simple, or should I really? Because whatever tables we discussed for the last 3 hours, we have discussed table by table, turnover by turnover, and all that. But we were talking about working papers, trails, credit note numbers, and so many other things. But when you download a GSTR 9, it is so simple and easy, where you have all the numbers auto-populated. So can we just proceed with filing the returns? What are the risks we would face if we do that?
So the risk is now these children who are attending to this session, whatever number will know, because recently the last day for filing, for sending a notice for 17-18 got over, 30th September. So the tax audit happening, return filing happening, the gamut of notices come, they tell you how important filing GSTR 9 is. Because it is very difficult. See, there is a paradox, simple is always difficult. Whenever they say something is very simple, it becomes the most difficult one. Because these notices normally are auto-populated notices, which come as a comparison with GSTR 3B and GSTR 1. The data that we submit in GSTR 9 never gets reflected anywhere. So this GSTR 9 and 9C, with proper working papers, if you are able to give the correct details, then handling notices becomes a very easier job. It is very difficult to handle this ITC related data, because you have to have an accounting knowledge first. You should know what is debit and what is credit. Of late, with the advent of information technology, for everything there is a software. You have a ERP, you have a Tally, you have SAP, you have this, you have that. So what happens? You have these so many. And with the introduction of GST, you've got multiple accounting softwares coming into the market. So you have a easy tendency and says that when everything you put in Tally answers, everything in put in SAP answers, everything. It is not so, because Unless and otherwise, you know the basic concepts of accounting. What really is a debit? What really is a credit? Whether and what are the rules that you have to apply for claiming the input? It makes a lot of difference, because that is what we are trying to explain. Because with respect to, because it's a small forum where the students who are pursuing their CA are attending, this is not only for the purpose of assisting in filing 9 and 9C, even for the purpose of exam, where how these questions are being termed with respect to ITC. There will be a practical scenario, say for final students, to give a particular set of ITC and say, ask them to determine whether it is eligible or not. So what is eligible to you may not be eligible for me, right? So it depends case to case basis. And with respect to a course like a professional course like CA, you should have this analytical skill of answering. When you answer in an examination, you don't answer as a student for the purpose of getting that 40 marks. You answer as a chartered accountant, giving a solution to a case study that is being presented to you. That approach is only very, very important. Say, for example, with respect to the portal that is given, if you go to the returns option, you have a tax liabilities and comparison. How many of us we download that when we try to compare whether the figures are correct? It has never been correct. And the auto-populated data, you always say auto-populated is not correctable. But have we ever tried to go to the in case of 2A, you never go to the second sheet and verify what are the credit notes that are being reported. So everything is available in front of you. Only thing is how you utilize only matters, so that you will be giving you the best results. And these working papers are very, 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 very important. From the beginning, I've been telling that. Otherwise, it is very difficult. Like, because it's a continuous process. The GSTR 9 and 9C of 22-23 is not a standalone document. The GSTR 9 of 21-22 has an impact, and the GSTR 9 and 9C of 23-24 also will is going to have an impact. So it's a continuous process of auditing, where we keep updating the things. You and I, as we speak today, we do not know in tomorrow morning there might be a circular or notification telling that this is mandated for the current year. Take the case of HSN codes. That is one finest example of reporting HSN codes. What is the classification that you have to follow? So you will have to have an overall understanding of the entire process of GST, because that has become a way of life. Had you understood that, like as I told you, even before doing a tax, there will be a time where there may not be a tax audit separately and a GST audit separately. We are going towards that direction, because on a genuine tax audit or audit finalization should have been completed only after verifying the figures for GSTR 9 and 9C. And in the near future, there might be one combined audit of GST audit and tax audit that is not very far away, because this GST audit work of reconciliation between the books and returns covers nearly 75% of the entire books of accounts, except for the deferred tax activity with respect to depreciation, or calculating the time difference, or with respect to the compliance of ICDS, right? For which we may not have much of an work. Once, if you see, for clause 44 of 3CB 3CD is just the beginning. To see that on a future date, maybe next year or maybe next year, when the direct tax code is also happening, there will be a day where we'll be talking on a different forum about how to do audit. It is not a tax audit separate or a GST audit separately. We'll still continue to do the audit, and the audit will always continue irrespective of whatever changes that happen. That is my concluding remarks for this session. I think we have taken much of a time. 2 or 45 minutes is too long a time, Shubha, to hold the students of because they're used to preparing for 16 hours, 8 hours continuously. For them, it is going to be much easier. So let us not pressure them with much more data on 9 and 9C. If we do not have any questions, then I think it is time for us to conclude for the day.
Perfect.
And let us thank Shubha on behalf of Shubha and my own self. I thank Mini Chandran, Valarmadi, Manohar, Joji Jose, Moksham, YASO, I do not know what the name is, Akhil Krishna, and Deepika Uppu. There is one Siva Prakashan. All these were the students who really kept us going, because they kept posting the questions in YouTube, and both of us had the comfort feeling that we are not talking to a system, but we are talking to a group of CA students who really wanted to learn. And that gives us a sense of Bharat Kumar. I am just running through the what's YouTube messages. We have one Sanjeev Vlogs is there. I'm trying to name all of them because it's a big thank you from both of us, because they kept us alive and they were able to guide us to giving them more and more information. And specifically Nivetha and Kavin for really being with us, helping us with the slides and all those stuff. And of course, for giving us one more opportunity to be with the group of young students as always. Thank you, everyone.
Thank you.
Shubha, would you like to add anything?
Do you have anything to conclude, or shall we?
Thank you so much for your wonderful session, ma'am. Really, we felt interactive and everything. We didn't feel bored and we learned a lot of things, and thank you so much for you.
Thank you. Thank you so much.
Thank you and all the best.
Thank you. Bye-bye. Happy filing.